In moments of suffering, greatness is born.
Correct. That is correct.
The best thing anybody can do right now is line up your Rolodex. Whether you can get liquid or not, don't know. But if you can't, then you need to be attached to people who are and be great at locating opportunities and making great connections. Because you either have the money, like you said, or you have the tools. And if you're lucky enough to have both, great. But you got to bring one or two to the table, like the knowledge and the tools, or you got to bring the money. So if you're getting your butt kicked, no different than when I was getting my butt kicked in 2008 in the financial crisis. Well, that's true. And I didn't have the money to go buy properties, but I just knew we had to buy properties.
Today on the show, I have the pleasure of speaking with Justin Brennan. Now, Justin is the CEO of Brennan Pole Group, a private real estate firm focused on acquisitions and developments of apartments throughout the United States. I'm really pumped and excited to have him on the show to share his incredible insight and knowledge. But enough out of me. Let's get him out here. G'day, Justin. Welcome to the show. How you doing today, mate?
G'day. I mean, I need to change the Aussie. I need to get into the Aussie accent, but maybe I'd do it totally wrong. G'day, mate.
Yeah, it's all good. It's all good. I know we're talking in the green room about a bit of a story back in the day. You went to Australia and had a hell of a time.
Well, yeah. Actually, when I was a luxury real estate agent, I was working for a company called Harcourts, right? And they're New Zealand based, but Aussie as well, and massive following down there in Australia. So I had a chance to go down there. I want to say in 2018. And speak in front of their international conference, couple thousand people. But man, what a wild time. You Aussies. I love it because Aussies and Americans, we love each other. It's just, you guys love us. We love you. It's a great time.
That's awesome. So that was not too long ago. Is that when you were back in the luxury real estate? And this was before getting into syndications and stuff like that?
Yeah. So I finished, I'd say I transitioned 100 or nearly 100% out of the luxury game in 2021. So not too long ago. It was the work up to that, because like with anything, if anybody's in like a 9-to-5 or any kind of other career and they're trying to side hustle into something else and move the needle for themselves, to just jump is fine. But, I had to supplant income. So I was doing quite well in the luxury real estate space, but had always built a portfolio with my business partner, Chris. We'd started with $100,000 condo. And that was in the midst of the financial crisis in 2010. And then we slowly grew that into kind of duplexes, fourplexes. And then we got into 5 to 10 unit deals. And then we realized, heck, if we want to scale, we need to do that, but probably out of state because we were in California. And it was just our money or dollar wasn't going to go as far. But that meant a whole other set of logistics, because now you're out of your backyard mentality. And now we're going into areas like the Midwest and Texas, Missouri, Oklahoma, and other areas that we're in today.
I skipped over the first question that I usually ask all my guests, and that's rewind the clock, I should say, and tell me how you made your first ever dollar as a kid to help set the stage for people and your background.
First dollar was actually, coming out of college. I could have done the "Hey, Dad, where's my job?" thing because he was a builder guy, but I didn't want to do that. I wanted to kind of make my own way, at least have success, and be able to say I did it on my own without having to go back to parents and that whole reliability thing. So I did that. I was a title rep in San Diego for a few years, but then always I knew that was just a process and maybe a stepping stone. Went back to grad school, got my master's degree, both in real estate development and business finance. And then came out into the real world, was doing development work with my dad for a few years up until the financial crisis. And then watching that all implode in 2008 and watching my dad lose everything. But it taught me some extremely valuable lessons, things that I've never forgotten and take into business today. And then got into becoming an asset manager. So they always say, you're either going to play the positive or the negative side of real estate, depending on recessions and times. So obviously that was a really rough time for a lot of people, if they can remember that. And I got into the negative side of real estate, which was I was an asset manager for a lot of the major banking institutions in the United States, handling their foreclosures and REOs and deviling them out to real estate agents to help the asset management side all around the country. And I did that for about 2.5 years, and then kind of saw the needle moving from foreclosure, right, an REO, where the bank controlled and owned the property, to short sales. And that's kind of where the homeowner still owns it. Now they're just going to sell it for less than the loan on it, but they have full control of it. So it was perfect kind of transition period for me. I had my real estate broker's license. And I said, well, gosh, I see the needle moving. Who better to help out a homeowner than somebody that's coming from the bank? So I literally came out with my real estate broker's license, and we helped out a tremendous amount of people in the Southern California regions, specifically San Diego, do short sales, and helped them out in really tough financial times to either give them more time in the home, relieve themselves of the debt. But I was able to do that really well because I was coming from the bank. I knew exactly what the banks were thinking. So I could actually go in there and really help the homeowner out and navigate a very chaotic situation. And I did that until it became more traditional real estate. So that was 2010. And then it became more traditional real estate in 2012, 13. But at that time, we were also starting to buy real estate, right? And this was with my business partner because we were started with a $100,000 condo, right? And then we got into that stuff of duplexes and all that other stuff and kind of grew to where we're at today. So I was doing them side by side until I got to a point where I said, listen, it's time to go. And I made the full transition. You
mentioned something earlier about the lessons you saw your dad learn from 2008. It's felt a little 2008-esque to me in the last 12 to 18 months in the commercial real estate side. I don't know if you agree with me or not, but volumes are down. I'm hearing banks are starting to not necessarily take back deals, or some deals you see in the headlines, but what were some of those lessons that you look back on in 2008 and you're setting yourself up for success today in a world where we're having hallmarks, maybe not as serious as 2008, but it's, it feels in some sectors that it could be?
Don't over leverage. Rule number one. So my dad was really good at making a lot of money. His income would mimic the real estate cycles because he was in the build and sell game. Right? Hey, let's build and then we sell, build and then we sell. And that's great, making huge pops and made millions of dollars. But he also lost millions of dollars because his income would mimic the real estate cycle, right? It was great when it was great and it was bad when it was bad. And for me, I don't know. I'm like, Dad, how do you sleep? How do you even do this? And he's like, I don't. I'm just kidding. But I learned a lot through that. And I realized that the real game, because he built, probably 4,000 or 5,000 apartment units in his career, and then single family and some commercial stuff, et cetera. But in the multifamily space specifically, but he never kept any of them and didn't keep equity in them. And I'm like, well, that's mistake number one. So for me, I went into it saying, well, when this happens again and we go back into this, yes, it's not as sexy to go and put capital and hold on to an asset for a long period of time, but the equity is really built in that. The true wealth is really built in that. The tax advantages are built into that. Refinancing and leveraging and kind of growth is built into that model. And yes, it requires more patience and more capital to sit longer. So it's not as fast a burn and turn, but you're also able to sleep at night because your tenants in a building are paying off your mortgage and paying down your debt and then cash flowing you. And you're just growing wealth over time. And then every 3, 5, 7 years, when interest rates are favorable, you refinance that property, pull cash out that's tax-free, and you keep copy, pasting, and repeating that baby. So once I understood that game, it was a no-brainer. So that's where the apartment space and the multifamily really stepped in for me, is not over-leveraging, using passive income growth and tax benefits to grow wealth.
Talk to me about your portfolio today and where you're acquiring assets. You mentioned you start looking outside of Southern California. What's the strategy and what's the sort of size you're going after these days?
In simple terms, we want to be Walmart surrounded by Neiman Marcus, JCPenney, and Nordstrom, right? And I say that, people are like, what? I say that because if you think about this for a moment, in good markets, people always shop at Target and Walmart. They're always doing well. In bad markets, people are always shopping at Target and Walmart. And more importantly, the wealthy have to shop at Target and Walmart too when you hit recessions. So the point being is if you are the B-class asset surrounded by all the A-class assets, then you are always full, right? Good markets, you're full. Bad markets, you're full. So the B-class asset is always the best one to be in good markets and bad. And so that's been our philosophy is I want to be, I call it the ugly duckling on the block, but I want to be the B-class asset in a great location surrounded by all the A's. And so that's what we look for in the assets we acquire in the locations as well.
Are you looking at average household incomes when you look at that sort of stuff?
When we're looking at markets to start with, it's always jobs and population growth, Because if you have good growth markets, right, the population tends to gravitate towards it. So it's always typical job growth of 2% or more, population growth of 1% or more per year. And that's kind of the 10,000 foot level. And then we start dropping into other little factors, location. We all know that in real estate, but some people tend to sacrifice it when they start seeing on paper, oh, look at the cash on cash, or oh, look at the cap rate, or oh, look how attractive, or look at the potential. I'm like, yeah, but when markets change, and they will,
and they have,
everybody fluctuates and gravitates towards job centers. And so if you're out in the boondock tertiary markets, when the markets are great, awesome. But when the markets are not, you're going to have vacancy problems, delinquency problems that are going to go through the roof as people pull away from yours to go find the jobs in a recession because they got to move to the job centers.
Right. No, I completely agree with that. We have transitioned in the last 12 to 18 months that we will not look at a property anymore with the average household income within a mile is less than $60,000.
Okay. Yeah, ours is 56. So we're right in there.
And the reason we do that is because we have had assets, and we do have assets in those, sub $50,000, and it's the delinquency we're seeing in this market, and in when the pinch, particularly in the recent interest rate hikes, the higher for longer, is hurting tenants, and they can't pay for it anymore, right? So the cost of living is going up, and it's something we're not, as a company, willing to sacrifice on anymore. So we bought an asset earlier in the year in Tempe, Arizona, average household income with over $100,000 within a mile. It's a Class C plus building built in the 70s, flat roofs, chiller systems, but Sprouts is directly across the street. And so,
so you bought one with a chiller?
Yep, bought with a chiller.
Are you getting the chiller system? Because you're talking about a chiller system that's one chiller for the entire complex.
Mm-hmm. Yep, on a loop system, and we're not afraid of those. But to your point is like we are compared to the Class A in the area. We are $300, $400, $500 below them because we're that affordable. And we're also 2 and 3 bedrooms. So it's like everyone wants that. And the fact that Sprouts are across the street, like they're smarter than we are, right? We're just going to follow them.
And these guys are running better data than you.
Oh yeah, 100%. We're the small fry. We're just. But that's an example of a deal. And I can only point to one other deal in my portfolio over the last 10 years. 24 different syndications we've done that has a better average household income within a mile. And so it's an example of something really to look at as you're talking
about median household income, right?
Medium household income.
Gotcha.
Yep. So it's if you've got access to CoStar, and I'm sure you do, but we as a company now quickly screen. Like if that doesn't meet that $60,000, we're not looking at it. Particularly if you're going to go older vintage assets with the boilers and the chillers and the problems you're going to have from that.
Yep.
Well, you got to want to be paid back on the other end, which is a more resilient market. People want to live in it and all that sort of stuff.
Yeah, no, and Tempe's coming back to earth, which is nice. The Phoenix markets finally, and some of the other areas in Austin and stuff are coming back to planet Earth. So
100%, and we can talk a lot about that. But back to your portfolio, you mentioned also ground up construction. I happen to be a structural engineer, former structural engineer, work for a developer. I've come from they say the tools. You come from the equity, the sort of financing side, or you come from the tools. I came from the tools, similar to yourself. What are you building right now? And are you looking at stuff only to build in Southern California or elsewhere across the country as well?
Our partners and us, we just completed a 160 unit deal in Las Vegas, Nevada.
Wow.
So that was a townhome build for rent type product, beautiful project called NOLA Sky. And that's an up and coming kind of not north, but kind of middle central Las Vegas near the executive airport. But like Agora Development's building a master plan about 1,000 yards away from us. So it's all coming our way. So that's a beautiful brand new construction townhome style build for rent product, 160 unit, built in 44 plexes.
Mm-hmm.
Right. So what's unique about that is you can sell the entire 160 unit complex, or we also have 40 individual APNs for each fourplex. So there's options for exit, if that makes sense.
Yep.
So there's that one. And then we have a couple in San Diego. We have a 20 unit we're finishing entitlements on right now for permits. We probably won't build that one. We'll probably sell that off to a merchant builder that wants to build it. But that's a great property as well and a great location in San Diego. So yeah, all of that. ADU game, you're in Southern California too, but San Diego's huge on that because of the SB 9 and SB 10 laws and stuff that have happened, those Senate bills. Because of the challenges in the housing game in Southern California and the cost of housing, they're trying to say, hey, listen, we're going to make it super easy and streamlined for people to put little accessory dwelling units on the back of their homes. And it's only in certain areas like urban zones and, certain criteria. So it's not like someone's putting a triplex out in a suburban market. So they're specific to high density zones.
The only thing I see the problem with the ADU game is the scale of it as a syndicator. Hence why, going out and building a BFR. We're actually building a 66 unit build for rent in St. Marcos, Texas. Same sort of thing, but we're doing duplexes.
Great market, by the way. That's incredible market.
So we're doing the same thing, seeing a shift towards that. Probably a little bit late to the cycle on that. But how much are you looking to continue to buy existing multifamily as we're coming into sort of this? You mentioned Tempe's and the Austins of the world coming back down to earth. Are you seeing opportunities right now in the existing space? Continue to add value, and when the 6 other dudes before you've already added all the value?
Yeah, there's still plenty there. We are still in the beginning stages of the cycle event because, as you are well aware, the amount of bridge debt, variable rate financing that's been placed on apartment multifamily, commercial real estate in general, but let's say multifamily over the last 3 to 5 years is in the hundreds of billions.
Mm-hmm.
And all of that's coming due. And it's actually was starting to come due this year in 2023. A lot of people were able to raise some capital through capital calls and kick the can down the road into 2024. But between 2024 and 2025, things are going to go down. It's either going down, meaning they're going to do some workouts and do workouts, some of them. Some are going back to banks and some will get sold at discounts. That's how it's going to get done. But it's different than, like, say, the foreclosure financial crisis of 2008, which was residential based, because that was very public, right? And it was very on CNBC, your television screen, you're seeing people kicked out on the curb and it became viral, right? Different, because the commercial space game is done behind the scenes. So a lot of this game of acquiring these deals and working these deals isn't going to be out in front as much. It's going to be, hey, do you know the asset manager at one of these debt funds and we can get in there and take some bad debt off their books type scenario. So the negotiations are behind the scenes. It's not on the front page of CNBC, even though the debt problem is massive. And you have a handful of debt funds around the country that have done a vast majority of the variable rate funding, right? There's a handful of them right now that have a lot of challenges. And so they're going to have to do some workouts.
Is the big one.
What's that?
ARBA, MF1.
Yep.
There's
MF7 just did. It was MF1 or MF7?
MF1 is the lender on a lot of some big portfolios of syndicators. Yep. And I think that's interesting. You say that Benefit Street, yes. Yep. Bridge Financial Group. There's a lot of groups out there. Now, I think that's the interesting part about what I mentioned earlier about feeling in a recession, but it's not necessarily on the front page, right? Mm-hmm. It is felt recessionary to me as an operator based on the data we're getting from our delinquency and our tenants and our rents. Like, we had really good rent growth coming into the summer this year.
Yep.
And then we saw it fall off a cliff.
Yeah.
And we saw
delinquencies rise.
Delinquencies. Right. It was something in the summer. And this is not just Phoenix or Texas. It was happening across the country.
Yep.
And we've got 5 MSAs that we're in. And we're like, what the hell's going on? Now, some markets were worse than others. Phoenix has been worse. And some are saying, oh, it's the deliveries and all this sort of stuff. But I'm like, my rental check, my tenant base isn't for $1,000 studio. They ain't going and paying $1,700 for the new build 1 bedroom.
Yeah, it's not, the Class A is going to get hit by Class A in the short term, right? In terms of supply issues. So that's true. But
I don't know if a Class C is getting whacked with the new deliveries.
No.
And it'd have to be like, I'm not the economist and I don't have the gray hair to say it's not going to get whacked. I just don't know if that's the direct result. It has to have an impact. I just don't know if that's the direct result. I think there's more of an influx of re-household formations. I think I saw a lot, in my opinion, we saw a lot of people with money in their pocket in COVID and like, I'm going to move out of my parents' house, or I'm going to, I don't need that roommate anymore, particularly in the C plus B minus space. And now I think there's a little bit more of a shift going the other way. I don't have the real-time data, but it just feels like that. And then back to the point of, I'd love your 2 cents on it, is just the, I'm part of a bunch of masterminds, which I know you are, and we're going to get to it here in a second, but hearing some of the distress that's happening out there, but it's not in the public eye, and investors are getting whacked.
Yeah.
And it's going to be a lot of pain, right?
Yeah.
It's already happening today. And I don't know how that's going to play out for all of us in the syndication space. Does the syndication will become the dirty word?
Well, when they say in moments of suffering, greatness is born.
Correct. That is correct.
So the best thing anybody can do right now is line up your Rolodex. Whether you can get liquid or not, don't know. But if you can't, then you need to be attached to people who are, and be great at locating opportunities and making great connections, because you either have the money, like you said, or you have the tools. And if you're lucky enough to have both, great. But you got to bring one or two to the table, like the knowledge and the tools, or you got to bring the money. So if you're getting your butt kicked, right, it's no different than when I was getting my butt kicked in 2008 in the financial crisis. Well, that's true. And I didn't have the money to go buy properties, but I just knew we had to buy properties. So I went and found my buddy, Christopher Poley, hence the Brennan Poley Group. And I said, listen, Chris, I know we need to buy some properties. I can't do it right now, but I can go find the deals. I can underwrite them. I can put them together. I can manage them. I can do I can run the company. I can run everything. I can bring sweat equity up the yin yang. I said, what I need right now is capital for the down payment and somebody to sign on the loans. And then I said, for that, we'll work out a deal. So we did. And then I became kind of run everything, and he just collect checks, and we both collect checks, but we would split that. And we started $100,000 condo, Murrieta, California. And then we grew that into duplexes and fourplexes, and then 5 to 10 unit deals, and then 20 to 50 unit deals. And then now we're doing 100 plus unit deals throughout the country. But that's how it started. And I would say the same thing here is if you were getting your butt kicked right now, it's very easy to go tuck your head in the sand. But the only way out of that is going to be to make sure you're connecting yourself with great people and be an incredible deal finder. Because I got a feeling, and I hope I'm wrong, I hope I'm wrong, but I got a feeling that what's coming down the pike is actually going to be worse than 2008 and 9. It's going to have nothing to do with real estate taking us in. Real estate took us into the financial crisis. It's not taking us into this one. This one's going to be currency based, and you can see it coming. I mean, there's a reason why they don't care about the debt and it's getting pumped up. There's a reason that the fiat dollars, we know it, the world's reserve currency, is on its last leg. And there's a reason why the Federal Reserve has started the digital dollar. There's a reason why China has started the digital yuan. There's a reason why you have the Fed now and the CBD systems and all the other stuff that's coming to fruition. There's a reason all this is happening, and that's to move the US dollar off the world's reserve currency. And when that happens, the day of printing money like we're printing now is gone. And what that looks like in the short term is probably chaos. I don't know, but it's not pretty. It's not pretty. And I think the US government, the Federal Reserve, are trying to find a way to do this with as least pain as possible, because the 32 trillion in debt, or whatever they want to call it now, is massive. And the reason they're going to have to lower interest rates next year, like in 2024, they keep talking about it, lower interest rates, lower. Well, the interest rates aren't going down unless the job reports show otherwise, except that I also didn't know that a vast majority of the treasuries, right, that are at lower interest rates are coming due next year during an election year. So they're going to have to reduce the interest rates so that way the debt service that the US government is paying doesn't triple overnight and implode the entire thing. You see where I'm going with it? So what they're basically, what Jerome Powell's sitting there looking at saying, okay, well, the jobs report and certain data doesn't really give us the indication we should lower interest rates, but we're going to have to do it anyways, because if we don't, and all these treasury bills come due and now they're kicked up at these higher interest rates that we're stuck at, our debt service as the US government is going to literally double and triple overnight. And it's going to make that 32 trillion look like peas in a bucket. So we have to lower the interest rates, because it's either higher inflation or implode the US economy and government. And like they're literally in that situation now. So they're willing to accept some inflation and knowing that, hey, we drop interest rates. Yeah, we understand stuff's going to kick back up again, but it's either that or our debt service is going to triple.
Yep. No, I agree. And I speak to a lot of different folks about that exact same thing. It was always going to be a game of chicken of how long they could keep interest rates higher for when they're going to pay on their own debts. It's a problem not just the US is facing, it's happening across the globe.
Mm-hmm.
And this has been a very interesting phenomenon where 2008 was a US problem that percolated across the globe. Today is like we all had COVID, we all printed money, everyone has now got high inflation, and everyone's sort of in the same, the same headlines you're seeing of, cost of living crisis is happening in Europe, it's happening in Australia, it's happening in Asia. Like all governments are facing the same thing, coupled with the fact that you've also got, when you've got the US dollar at such a high, the US treasuries at a reserve currency is so high, when other countries are borrowing in the US dollar, their debt service goes up as well. And so now the US is only focused on the US itself, but there is the higher US dollar causes political unrest across the rest of the world because people are borrowing in that reserve currency. So
hence the reason the BRICS, right? You kind of watch the BRICS thing.
Right.
So people keep asking, what's going to be the thing that what's the next crisis?
Mm-hmm.
Currency.
Yeah.
It's currency. 100%. It's staring at all of us.
Yep.
And if we don't want to look in the mirror and pay attention to it, then we're going to all of a sudden wake up one day and go, oh my gosh, that seemed like it happened overnight.
Right.
No, it didn't.
Right.
It's been ongoing it started during COVID, because that's when China started to launch their digital yuan, and Jerome Powell stated during 2020 that they were going to start the digital dollar.
But digital currency has been around probably for at least a decade.
But how it's used,
correct,
transitioning off the fiat, right? The fiat US dollar, because the dollar has been the world's reserve currency since 1971, when Nixon took us off the gold standard. And ever since then, the US has been the world's reserve currency. All world reserve currency, if you look back in history, not that history is any indication of future results, but what else do you have to go by? Most world's reserve currencies last 40 to 50 years. Most. If you do the data, 1971 to where we're at today, I think we're at around 51 years, if I'm not mistaken.
Good math. Carry the one.
So we're right there. We'll see. I don't know.
No, I think I agree. I completely agree. And I was speaking at a conference about this with some people way smarter than I am about this exact same thing. And that will cause a lot of turbulence if the US dollar is not the world currency. It's inevitable that it's going to happen and it's going to shift. That's why you see the governments around the world starting cracking down on these digital wallets and digital currencies, and having a plan in place to not control them. What's the word I'm trying to look for? To like go and create policy around them so they can profit from them as well, because that's part of the reason they don't have any control right now, and that's where it was starting to get dangerous. And then we saw a massive crash in Bitcoin. I'm not an expert again either, but you can see the hallmarks of governments starting to get the hell on board because they know it's a train that's already left the station.
Yeah, you're right. The governments are trying to make sure that they can contain, because if they don't have some mechanisms of control over the currencies, right, the central banks, they're screwed and they lose a lot of power, and they know that.
Right. That's right. Well, mate, I'd love to keep chatting with you, but we have to dive into the top 5 investing tips. You ready to get into it?
Let's do it.
Mate, question number 1 is, tell me the daily habit you practice to keep on track towards your goals.
So I read this. I've been reading this book, almost finished with it, Atomic Habits. I don't know if you've ever read that book.
I haven't, but I know about it.
Yeah, by James Clear. Incredible book. The thing I've been focused on now is habit stacking, meaning if you're trying to change something or get a better habit, you want to plug it in between things you're already doing that are good. So wake up at 5 a.m. After I wake up at 5 a.m., I'll make my bed. After I make my bed, I'll do 10 push-ups. Right. So you're stacking things in you want to do inside of things you already do. After I've done 10 push-ups, I'll make a cup of coffee. After I have a cup of coffee, I'll listen to 10 minutes of meditation and affirmations. So I've been doing that, because if you master your morning, you master your day. I'm a huge believer in that. You master your morning, you master your day, and you get that rhythm going in the morning, and it's going to make your day incredible. If you get out of rhythm in the morning, 100%. That's when you feel like, oh gosh, like you're just going on tangents, and it ends up being a bad day, as you would say. So that's huge, doing the morning routines and having that lined up, and then really trying to focus on habit stacking to do better at things that you're not good at.
Awesome. Question number 2 is, who's been the most influential person in your career to date?
In the career side, between my dad and probably Rudy Medina. So Rudy Medina is a co-general partner on some of our deals. I've known him since I was young. He's actually Grant Cardone's former partner here in San Diego. So I don't know if you know this, but Grant Cardone started his multifamily career here in San Diego.
No, I didn't.
And his first two multifamily deals were with Rudy Medina here in San Diego, because Grant Cardone was living on Camino de la Costa in La Jolla, walked across the street one day, met a broker lady, ended up buying that house with some partners on the waterfront for $4 million and change, flipped it for $9 million and change. That was his big chunk of money. And from there, he ended up meeting Rudy and a few other people, got into multifamily. One deal was a 27 or 30 unit deal in Point Loma, San Diego. The other one was a 47 unit deal up in Vista. They partnered on together, but he's been influential in understanding capital markets, financing, how to structure deals, and how to deal with stress. Dealing with high stressful moments, because it's going to happen and you don't want to panic, and you need to make sure, at least in my line, you got to get your big boy pants on, and knowing how to maneuver through those moments without losing your what.
Yep.
Critically important.
Yeah, 100%. Question number 3 is, what's the most influential tool in your business? It could be a physical tool like a journal or a phone, or it could be a piece of software that you just can't run the business without. What is it?
So we use Syndication Pro, at least on the multifamily side, to help the investor relations. But for me, I live and die by my task list on my phone. So I seriously, you go in, I have an iPhone, so I have the reminders, okay? But I have them all like categorized by properties and by what it is. So all my tasks are in there, and I can click on this and it's got everything that I have. I mean, it's super resourceful. And that way I live and die by the tasks every day. And that's how at least I feel accomplished, when I can go through and check all this stuff off every day for moving the needle.
Love it. Love it. Question number 4 is, in one sentence, what's been the biggest failure in your career, and what did you learn from that failure?
In one sentence, what has been the biggest failure in my career, and what have I learned from that? I would say the biggest failure was a recent deal last year that we actually walked away from. It was a 200 unit deal in Schertz, Texas, just north of San Antonio, south of San Marcos. Is it Marcos or Marcos?
I own in Schertz.
We're in escrow, got in, money went hard. Fed started to raise the interest rates at astronomical speeds, and as we all watched happen, we were $800,000 hard in the deal. And we had to make the decision to either put a square peg in a round hole and close that deal, or walk from the deal, because the financials just kept eroding. After probably 2 weeks of hyperventilating with our partners, we finally made the decision. I said, listen, I'm not going to risk $12 million of investor money. Not going to happen. I'm willing to risk and walk away from our 800 grand, because we don't risk investor money until we close. So it was our 800 grand. We ended up walking from that deal and taking it in the shorts. By doing that, doing the right thing, thankfully it was the right thing, absolutely the right thing now. All those investors ended up coming into another deal that we bought in San Diego that was an 80 unit, that was a $22 million deal, because of how we handled that situation. They're like, wow, we watched you guys take it, and because of how you handled that and did the right thing, we're on board with you guys. So I consider that a huge failure, but also a huge win. But it was painful, right? Mm-hmm. It's a hard thing to do, to walk away from that, but it was the right thing.
It's happened. I own a deal in San Antonio that the exact same thing happened. Someone was trying to buy and they couldn't close, and we ended up taking their money. So we don't want to do that, but it was just the market shifted so quickly.
Yeah.
Last question is, where can people reach you to continue the conversation that will be in your sphere? Where do they go?
Instagram is probably the easiest one. Justin C. Brennan on Instagram. Follow me. We're giving good tips and advice, free information if you're looking to get into the multifamily game or any of that stuff. Love to be a resource for anyone. So
awesome, my friend. Well, look, I want to thank you so much for jumping on today's show. Just want to reflect some of the things I took away. I think it's so important that you've got that perspective of where you came from in 2008 and how that applies to today. And talking about, the publicity of 2008, the homes crashing versus what we're seeing play out behind the scenes in the commercial space, because it isn't in the public eye as much. And I think that is something's coming and something's happening in the terms of defaults in this commercial real estate space. So as listeners of this show, I think it's really, really important to get yourself and prepare yourself for what is coming, which is going to be an incredible buying opportunity in my opinion, and I'm sure in yours as well, Justin. And then I really, enjoyed everything around your mindset, and like knowing that if you have the right mindset, putting your big boy pants on, you can go through anything, right? And we're all going to face it. We're in the real estate space. I remember someone saying to me on stage one day, you haven't been in real estate long enough. You haven't done a capital call. And I was like, really? Oh, like, and that was such a, you're not that you want to do that with anyone, but you're putting on your big boy pants when things go bad and being able to take it in the shorts like you did on that particular deal in Schertz, Texas. You show investors that you got your big boy pants on and you can play this big boy game. It comes back in spades. So did I leave anything out?
No, that's it, man. Yeah, just treat, like you talked on the investor side, transparency. I'd say any capital calls we've ever had to do is, just be in good communication with your investors. The last thing you want to do is go MIA and silent, because then they know there's a problem. More importantly, and they don't trust you to resolve it.
Right.
So, but if you step up and have good communication and just don't bring a problem to the table if you have not provided or thought through a couple potential solutions.
Correct.
So don't just go throw problems at the wall and see what sticks. Like, okay, you got a problem, but think through a couple solutions and offer those on the table when you're talking to investors to say, hey, what would we like to do? Or here's the plan.
Yep.
It's relieving to them because they're trusting you with their money, and you need to take that very seriously.
Yep. Love it. Well, mate, I want to thank you so much for taking some time out of your day to come on the show. Enjoy the rest of your week, and we'll catch up very, very soon.
All right, man. Thank you. Appreciate it.
Well, there you have another cracking episode jam-packed with some incredible advice from Justin. Remember, you can go check him out on Justin C. Brennan on Instagram. Check out everything that he is doing in his world. I want to thank you all again for taking some time out of your day to tune in to continue to grow your financial IQ, because that's what we're all about here on this show. You can give this show a 5-star review on iTunes or wherever you podcast. And we're going to do this all again next week. So remember, be bold, be brave, and go give life a crack.